Hi, I'm Pattu from freefincal. Today let's talk about HDFC Developed World Indexes Fund of Fund. This is an NFO currently in the new fund offer period. This will invest in a basket of ETFs and index funds, which in aggregate will track the Morgan Stanley World Index, MSCI World Index. Now, this is a bizarrely constructed fund of fund, and just for that reason alone, one should not invest in it. Now, the MSCI World Index, it captures 23 developed markets, stocks from 23 developed markets, all the usual suspects: USA, UK, Netherlands, Finland, France, Australia, blah blah blah, and so on. But most of it is basically the US. So you can see from the top stocks, it resembles a S&P 500 to a very good extent, and it has got about 68% of US, about nearly 7% of Japan, 4% of UK, 3% of France, 3% of Canada, and the rest is 14.8%. Now, it's already a very US heavy index. So one might ask, why should I invest in this? I can just invest in S&P 500. Now, the point is that this invests in four funds. One is a ETF based in Ireland. This is tracking the USA index. HDFC says they have chosen Ireland as the domicile because the withholding tax of 25% on dividends is half for Ireland. So investors will get more returns. Then all the other three are domiciled in Luxembourg. There is a Japan index, there is an ex-Japan index, Canada index, and so on. All of them are domiciled in Luxembourg, and all of them are index funds. I don't know why they want to get into this kind of a complication. The only reason is they have some kind of arrangement with Credit Suisse. I mean, there are 9 ETFs that track the MSCI World Index domiciled in Ireland. So if somebody wanted to reduce withholding tax on US stocks, they can just choose one of those 9 ETFs, and only you just need to have a fund of fund with only one underlying fund, underlying ETF that is tracking the world index. Instead of that, they want to have this kind of a basket, and in aggregate they will track one index. Each of those funds will have their own separate indices. What a mess. It's an unnecessary confusion. And what is so special about this world index? Are you okay? You're going to get better diversified, but where is the great diversification today when USA is ruling the roost? You have Apple, Facebook, Microsoft, Google. They're omnipresent today, and the revenues they get is truly worldwide. So already in holding these 5-6 stocks, you're already built yourself a diversified portfolio. So I mean, where is the logic? If you look at the 10-year rolling returns, I have data from 1968 for the world index, the MSCI World Index, but I have only data from 1988 for the S&P 500. In this version, there are other variants I can use, but I just chose to use this. So the orange line is the S&P 500 total returns index in USD. The yellow line is the MSCI World Index. You can see that the orange line is pretty much on par with the yellow line. I mean, you can say it has betted, but I don't want to say that. They pretty much you're going to get similar returns. So what is the great speciality in this HDFC developed world indices that is investing in 4 funds on aggregate that will track the world index? There will be tracking error for each of those 4 funds. Then you will have a tracking error for the aggregate index. This is a total mess. Okay, I will be interested as an analyst to look at the tracking error of this fund when compared to Motilal Oswal's S&P 500 index fund, which also has significant tracking errors, by the way. But as an investor, I think there's nothing special about it. Please stay away.